Right, hello, and welcome to the Stage Analysis Members Weekend video part 1. So in the first part of the video that I tend to do on Saturday, I cover the various indexes, the market breadth, and some of the industry group relative strength. So in the second part of the video, which I tend to do on Sunday, I go through the watch list stocks and stocks in focus, any stage 2 breakouts, that kind of stuff. So it's much more stock focused on a Sunday, and it's much more index and market breadth focused on the Saturday video. So I've split them up into 2 videos now, as the individual video was getting a bit too long, so it was getting between an hour and a half each time. So splitting it up into 2 makes them more palatable, just over half hour to 45 minutes or so. So, and obviously different people are interested in different things, but in terms of for the stage analysis method, and Wyckoff, both are top-down approaches where we look at what's going on in the market, i.e., is the market in stage 2, and what the internals are saying via the market breadth. So we use something what we call the weight of evidence approach, where you look at multiple market breadth indicators and you take a kind of weighted approach to what they're telling you as a whole, not what any individual indicator is telling you. So I see a lot of people talk about individual indicators. You'll see the McClellan oscillators or moving average breadth or bullish percent indexes or whatever. Most people just focus on one or two. You only when people talk about breadth, they generally will only talk about the advanced decline line or occasionally the new high, new lows. But there's a lot more to it in terms of there's a lot of different types of breadth internals you can look at, and with on stage analysis I'll also have a few custom ones that I do myself, which is the plus and minus ATR levels. So as you can see here on this S&P 500 chart, the line in the middle is the 21-day EMA, and then from that we've got the plus 1 ATR level, which is this line here that runs up. So when you're in uptrend, the index or stock will tend to be above that plus 1 ATR level and the minus 1 ATR level, which is the line below here, in the middle. So that, and when a stock is in a downtrend, as you can see in the previous downtrend in September, or an index, you tend to be below the minus 1 ATR level. So one of the breadth indicators that I've come up with myself, which I'm finding quite useful in terms of looking for extremes and in the near term swings, etc., is looking at stocks basically in the short term uptrend based on where they're positioned compared to their ATR levels. So that one's quite a useful one. And another one that I've done for a long time is the point of figure cumulative breakouts minus breakdowns, using the double top breakouts and double bottom breakdowns on point of figure charts. So that is a very clean kind of chart and acts very similar to the bullish percent index, but on a much sort of faster level, and looks more like the advanced decline line. So basically it's looking for similar things. Like the bullish percent index looks for all point of figure charts on a buy signal, whereas the point of figure double top breakouts minus double bottom breakdowns is a little bit different. But in terms of it's looking for those just individual breakouts and breakdowns, and it doesn't. So you get it's kind of a cumulative effect and gives you a different picture to the bullish percent index. So I look at that and a few other ones that I do too. But for the most part, I just tend to start with these videos. We tend to go through the indexes first. So we'll do the S&P 500, Nasdaq Composite, small caps, QQQJ, which is the Nasdaq second 100 stocks, and the IBD 50, etc. And occasionally look at some of the other indexes as well and get a sort of general picture for that. And then we'll look at the industry groups. So we've got the Dow Jones US industry groups. There's 104 of those. So you can see they're based on the relative strength scores from what we get from stockcharts.com, and then go into the individual market breadth stuff and go through that in detail and tell you what I'm looking at and what the expectation is from that from the weight of evidence. All right, okay, let's begin. So today I'm going to start off with the S&P 500. It's been a really interesting week in the market. In terms of the stage analysis members, I basically have been signaling through the market breadth charts over the last few weeks that the market was getting a little bit toppy, and had started to scale out of positions in the run up in early November through to through to mid-November, and then exited the rest of the positions on Monday, just after, a little bit after the open, in the first hour or so, as the indexes were rallying higher, but the individual stocks were getting creamed. They were selling off hard. A lot of stocks were already down 5% on the day or so, or more, whereas the indexes were still up to about 1% up or so. So there was a weird kind of divergence going on at a key level in multiple indexes. So that was the cue to exit the rest of the short-term trades. Longer term trades in terms of investments and pension account stuff, I don't get out of very often, so no changes on that, and I'm generally invested mostly in the mega caps for the majority of that at the moment. So that's holding up reasonably well through this, and it's kind of a bit of a flight to safety as well initially for institutional funds. They tend to go to the mega caps first, and obviously the staples and sort of more defensive areas of the market. But it's when those kind of areas start to fall over as well, is when we can get into the bigger corrections and move into stage 4 declines. So at the moment, we're still, if we go to the weekly chart on this, you can see we're still in a long-term stage 2 advance, what we call stage 2B, so late in stage 2. So you can see from the weekly chart, which we've been in since July time last year, that was the stage 2 breakout in the S&P 500 there. Obviously, Nasdaq broke out much earlier. So from our short-term daily chart here, which has got the ATR bands on it, you can see we actually closed back below the -1 ATR level on Friday. So it's the first time it's been back below that minus level since early in October there, where it bottomed out. So when we first move into this, it tends to show with what we call a significant bar as well. So we had more than a -2 ATR move on the day from the previous close. So close to close there was about -2.5 ATR. So really big bar. Obviously 1 ATR is your normal range. So more than 150% of the normal daily range. So this is what we'll call a significant bar. So it's a reversal significant bar. So we've got a trend change going on here after some spring type action and a test and follow through. So that's a near term short sort of entry point on the S&P 500 until it finds support and tells us otherwise. There is obviously near term support quite underneath around this level down here, and obviously back into the range. But we'll see how it goes. Initially, this is moved to the downside, so it's on a negative at the moment. The VIX also spiked on Friday quite heavily, massive gap up, 54% from the Wednesday move from prior to Thanksgiving. Then obviously Black Friday here was moved up 54%. You can see as the S&P 500 then dived down there. Other indexes obviously getting hit equally hard, which we'll have a look at in a minute. But prior to this, throughout the rest of the year, the spikes above the 200-day moving average have tended to be near-term swing lows, except for the September one, where it actually started to come back in and then reverse back up again. So other than the September into early October area, most of these are formed at swing lows. So the fact that it's moved quite so far and it's near an area where it's peaked out previously, potentially we could be at a near-term extreme in that. So be looking to see how this reacts on Monday and if it can start to come back in again or not. Right, next up, Nasdaq Composite. So this kind of goes with the majority of the kind of stocks that I trade and I talk about on Stage Analysis members service. So stuff that gets into the watch list tends to be more growth stock related than not. They do get obviously other groups, stocks from other groups, so industrials and materials, etc., and occasional banks, but it's less. There's much less of those than there is of actual more of the sort of tech names and the general growth stocks, as they're much more tradable in terms of actual short-term swings. So and for position trades in general, but for longer term stuff, I also obviously highlight what's going on across the market. So anything that that looks good, I will highlight. But it tends to be, I've found over the years that it's more leans more towards the Nasdaq than it does the NYSE kind of stocks, which is more NYSE stocks are more financials and materials and industrials, etc. Whereas the Nasdaq is much more sort of tech heavy and communication services, etc. So on the Nasdaq Composite here, we can see we've closed back below. This dotted line here is the 21-day EMA. We made a lower low there, but we are coming into near-term support level, and we have got the 50-day moving average here. So feels like a 50-day moving average test looks due here with the extreme moves we've seen over the last week or so. If we go to the ATR chart on this, you can see we've again this closed just at the -1 ATR level, so 15482. We closed at 1491, so a little bit above the -1 ATR level, but it did dip below it intraday, so not quite a short-term trend change on this one yet, but it is in potential area where it could be on for short-term trend change. But you can see the volume was much lower going into the end of the week, as would be expected, as obviously institutional traders would have been taking some holiday following Thanksgiving. So it was a light day, and it was a short day on Friday as the markets closed 1 p.m. US time, so a couple of hours, 2 or 3 hours short of a normal trading day. So we can see we've got a little bit of a broadening formation on this one as well. So at the moment, so near-term support there coming up, and 50-day moving average. So we'll be keeping an eye on that at the moment, in line with the S&P 500 in terms of relative strength. The IWM, so Russell Small Caps, this on the other hand actually has come much deeper after the big base it's been forming over the last year since the February top. It basically it's been going sideways throughout the year, and we had this stage 2 breakout attempt back in late October here, which has now potentially failed as we have fallen back into the range. So we had what we call a sign of strength rally, if we were using the Wyckoff terminology, and then it came into the backup. It did attempt to hold on Wednesday, but then it fell through heavily on Friday with a -3.77% move and closed back below the 200-day moving average. It is back into the major range, but if we look at it on the weekly chart here, actually if I go this, I think I write it up here, so you can see on the weekly chart here with the massive base that it's in. It's still obviously big area of support, liquidity support from where it's been. But you can see these weekly bars in here. We'll zoom in a little bit on that. See these weekly candles have been expanding. So obviously on a pullback, what you like to see is the bars to get shorter and the volume to be decreasing on the way down. You can see the volume was increasing on the last 3 weeks here, and you can see the bars, the close to close, has actually been expanding. So what we want to see is what we call shortening of the thrust, whereas actually the thrust has been expanding. So, and we have closed back below the 30-week moving average there and the 10-week moving average. So this is not looking great at the moment. This needs to recover quickly. We've got this significant bar here now on the weekly. So if I zoom back out of that one. So if it can recover back through there and get back through the top of the range here, so at what we got there, high 235.74, so about 236, then that could obviously revert and come back into stage 2 there. But at the moment, this is looking like a failed stage 2 breakout attempt to new highs. So when in terms of, if we use the Wyckoff terminology on this is now looking like an up thrust after distribution. So which sometimes can be misleading, as a lot of the time the distribution actually happens after the up thrust. So you can't, it's hard to discern distribution in the actual range, but you can, a lot of the time, if we do start to see volume pick up after the up thrust after distribution, and then we get obviously a sign of weakness as it rallies, as it pushes down and then breaks below the low of the base before starting to come back up and forming a lower high and then rolling over again. So on alert for a move back below these near-term levels. We go back to the daily chart on this. You've obviously got multiple areas of support where it's formed higher lows on about around the 200-day moving average here. So you can see relative to the 200-day moving average, this is potentially one of the lowest closes it's had to the 200-day moving average. That was the from there to there in terms of distance. So you moving average there. So you can see we were about 0.65% below the moving average there, and you're about similar to that at the moment, 0.5% below. So it's close to the, on these points here, the most it's been below. So if it starts to another day below this, then that would be the weakest it's been throughout this entire base structure. And then if it can't rally back through, we need to see this get back through this 50-day moving average and fill this gap, because this is a significant bar on Friday. So you can see from close to close on there, that was almost 4%. So this needs to recover at least half of this and not falter at this 50-day moving average, or it could start to get ugly on that. But if it can recover back through there quickly, you can get a strong rebound and start to get back above this near-term area in here. So like I said earlier, on the weekly bar, about 336, 337 sort of area. If you can get back above there strongly on some strong volume coming back in, then it could shake this off. But at the moment, this is still looking a bit up thrust after distribution. And so the expectation would be for any rebound to form a lower high at the moment. So, but we obviously take it as it comes. But in the near term, its initial test will be to see if it can fill this gap and get back above this 50-day moving average. Right. The IWO, so this is the small cap growth index. So this has been generally weaker throughout the year than the actual the IWM, which includes the NYSE type stocks and the industrials and the bank stocks, etc. This is just the growth stocks. So we'll quickly show you the lower range on this. So this has been forming a base over the last year. We did have a little breakout attempt into stage 2, but it's failed again. Expansion of the thrust on the way down there. So each weekly close to close there. So if you see this close and then the following close and then the following close, you can see there each bar is expanding. So that's not a good sign on that one. Let's zoom in on this a little bit. Let's go to 1 year. Even closer. So mark this base. Right. So we take it from the selling climax into the automatic rally to the secondary test. So that's phase A in there. We had some testing in phase B, and then it started to potentially form into this was potentially the phase C area with a sort of LPS, which is called a last point of support. And then we had a rally in out into phase D here in the sign of strength rally. But what we want to see in the sign of strength rally, which is the stage 2 breakout area here. So your stage 2 breakout, you want to see this when it pulls back into the breakout level in order to hold the level. So you wouldn't expect it to come back in below that level. It should hold there, and it should have started to rebound, base up in this area and start to move back out to the upside. So fact that it's pulled back in, so this is a sign of the weakness. And as I said, we've got an expansion close to close here. We've got each close is getting bigger from the initial bars. So this bar here started off and it's getting wider. So that's actually the opposite to what we want to see, and it was on heavier volume here. See this volume, it's much heavier than we had on the previous weeks. So this is actually looking pretty negative at the moment now in the IWO. So let me get back to the daily on this. You can see we're below the 200-day moving average again. We have got some obviously near-term support coming in around 290 there. So these levels in here. So if it can actually hold into this area and get a bit of spring type action back up through there, then you could get a potential near-term pivot form. As obviously it's come off quite a lot. You'd want to see at least half of that come back again. So from down here, this low here, you need to, we got there 14-15%. So you need to see at least half of that recover, which would get it just back above that 50-day moving average. So if it can't get back above the 50-day moving average and starts to roll over in there, so if we get a move back up into the 50-day there, and then it starts doing that and moving off to the downside, then that would obviously be a potential for a stage 4 breakdown there. But if it can actually recover back above and then start to hold up and start to form a higher higher base and then move on out again, then obviously that would be a much more bullish scenario, and then that could potentially get you back into stage 2 again. But at the moment, we're back in the middle of the range here. It's looking weak below the 200-day moving average. So again, first initial thing this needs to do is recover these near-term moving averages, and around 50% of these bars here, this significant bar here on volume, so this is the key bar, this volume here. So this was this bar here on this day. So it needs to recover this level here. So if it can't get back above, we need to see this get back and start closing above up in this area. Obviously, probably not going to do that in a day. It might take multiple days to get back through there, but that's the level it needs to get through. So about 310-ish at the moment on that one. IBD 50, so this held at its 200-day moving average, unlike the small caps. So this is the CanSlim type growth stocks, so the larger ones of those generally. Again, this has been making a potential stage 3 over the last year or so. So we got our initial buying climax there. So we had your buying climax into your automatic reaction, secondary test areas. That's your phase A, some phase B testing, and then we had a potential phase C here with a local spring type action, and it's rallied up. We had our early sign of strength rally here, and then it pulled back in. So it's doing what we're seeing currently on the IWM. This one rallied out, had a failed breakout attempt, and has pulled back in, but it did hold at its 30-week moving average there. So it actually held that level there. And this obviously an earlier breakout level here, so it held around that earlier breakout level. We see we had multiple tests of this high here, so is actually in a support range here at the moment. You've got a little base on base type thing going on. So if we clear that out and do the lower base, from the lower base structure in here, you can see it actually has formed a base on base type thing. So we had an initial selling climax into an automatic rally, secondary test, etc. Then local spring action again in here, sign of strength rally, and the backup did come in and came back into the base a little bit, but you can see these little demand tails on these in here, and it's rallied back up again and out. So it's been forming a higher base here. So we've got a sort of fractal base on base type pattern going on at the moment. Although this again is a significant bar, you can see it's expanding in terms of the actual weekly closes. You can see the relative strength has made a lower low, so breaking down from obviously against the S&P 500. So this is underperforming the S&P 500 again after a little breakout move here back in August into September there. So it is looking weaker at the moment, but it is holding that 200-day moving average for now. So in the near term on this one, need to see this start to regain that 50-day moving average. You can see the 21-day is curling down there, and we're still below that. So we'll zoom it all the way in on the intraday 2-hour chart here. You can see we had a stage 2 up here into stage 3. We've got a stage 4 breakdown there. So we're on stage 4 on the intraday chart at the moment. So we need to see this firm up and then start to build a stage 1 base and rally back out again. Otherwise, obviously at the moment, for the moment, this is an avoid until it can start to firm up a little bit. So obviously it's in stage 4 on the intraday. Next up, QQQJ. Let's go zoom in on the 2-hour on this straight away. So you can see the stage 2 rally on this one into a stage 3 top, and then the stage 4 breakdown here on this bar here. You can see the moving averages are rolling over, and this is obviously breaking through these near-term levels. So you obviously would break down this bar here is your stage 4 breakdown level, breaking through horizontal supports, multiple horizontal supports, and a vertical trend line there. So coming out of stage 2 into stage 3 here, that's your stage 3 area, and now we're in stage 4. So until this can start to firm up and get back above these levels up here, the moving averages can start to turn back up again. Then this one is obviously again an avoid. You can see not much in the way of supply down here on the later part of the week. It was quite quiet, so it could be starting to form a base here. We could obviously have an initial base structure starting to form, but it's very early to tell at the moment. This could be a selling climax into an automatic rally and secondary test. So this could be phase A of an initial stage 1 base on the intraday, but we're obviously in the near term, that's all we can surmise at this point. At the moment, we're below the 50-day moving average, and we're above the 200-day moving average. So So get the ATR levels on this, and we're also below the -1 ATR level. So short-term downtrend, as we know, on the daily, and obviously from the intraday being in stage 4. But we are into an area, we're back into the top of the base range that formed. So again, if we go into the weekly on this, similar to what we see in the IBD 50, this one covers a broader range of stocks with about 100 stocks. You can see the bigger range here, we've come back into that, but on the lower range that formed from the initial selling climax down there, we've obviously got this sign of strength rally out of the range, and we're still above that at the moment. So we could still be in what we call a major backup at the moment, but taking it from the broader range, we've come back into the range a little bit. So we need to see this start to get back out the top of this area again and start to clear that, as it's obviously broadening out at the moment. The volatility isn't contracting, it's actually expanding. So again, not a great sign, and you can see underperforming the S&P 500 on the relative strength there. Right, that's that for the indexes. Let's have a look at the individual groups. So this is the Dow Jones US industry groups relative strength chart. So take this each week from Stock Chart's SCTR scores, which it's got about 6 or 7 different things that it uses to calculate it, but it compares pretty well to other relative strength scores that I look at. So Stock Charts covers the 104 industry groups, so you've got all of those in there, which is really useful for determining if you're using the weighted evidence approach and the top-down approach, which in stage analysis is called the forest for the trees. So whereas we look at what's going on in the major indexes, we go through the market breadth charts and the internals, and then we look at what groups are outperforming and what groups are weak, and then we look at individual stocks from those leading groups. So it's a top-down approach based on those sort of 3 tenets of market strength into industry group strength, and then into leadership from those groups, to obviously pick the best of the best, and avoid obviously the weaker areas of the market. But stage analysis is a long and short method. Obviously, when the market is in a stage 4, then we flip to the downside, and basically we'll be looking for shorts. But at the moment, obviously the internals being close to being in stage 4, but the indexes are still in late stage 2 and stage 3. So it's a bit of a mixed market at the moment. So you can be doing both long and shorts at this point in time, and for the majority of this year is how it's kind of been. So strongest group at the moment still remains automobiles. You can see I do 1 week, 2 week, 4 week, and 12 week. So we cover up to 3 months of RS changes here. So you can see 12 weeks ago the automobiles group was 44 lower. There's 104 groups, so not quite 44, but it's just in terms of, for the video purposes, it was 44 lower. So that is our strongest group at a score of 100, and your weakest group is Brewers, which has been the weakest group for the last 3 months. As you can see, it hasn't moved for 3 months. It's been the weakest group. So that's one way this can happen in terms of the strongest group for the last month has been automobiles. And so how I use this information generally is we're looking for groups starting to move up from the lower area. So earlier in the year, automobiles was actually one of the weakest groups, as was renewable energy equipment, which you can see has moved up 81 places there in the last 12 weeks. It was actually the weakest group for a little while earlier in the year. And since then, it's been forming multiple stage 1 bases and started to break out into stage 2 in a number of the names in the group. So it's risen up quite strongly and moved up into the top 10 in the last few weeks, but has fallen off a bit over the last week, down 10 there, which has taken it down to 17th. So you can see it was up about 7th or 6th last week, I think. So gold, another one that's been down in the bottom for the majority of the year. So as is mining and various other ones in here, airlines and gambling, etc., have all been particularly weak. So in terms of our strongest groups, we've got automobiles, semiconductors, food retailers, home improvement, transportation services, specialty finance. So you can see a lot of these top 10 names are not great areas that I like to look at the moment. My focus tends to be automobiles, semiconductors, software, computer, hardware, and renewables, and those kind of areas. And I kind of dip in and out computer hardware there, and obviously I dip in and out of the other groups as they tend to be much more for longer term, like the kinds of home improvement retailers and house builders and things like that. They do well for longer term investor method type plays, but in terms of short term swing trades, they're not great. The growth kind of areas are much more amenable for those kind of trades. So at the moment, if we flip it to a 1 week change here quickly, you can see telecommunications equipment was the number one group this week, moving up 21 to a score of 68. So not great in terms of the RS score. If we look into the group, the individual names here, I had a look through some of these, and none of them are particularly great. Pan W is one of the leaders low, so you can see from that this has been one of our near-term leaders. So good stage 2 run on that one. Whereas we've also got, I'll go back to this again on the 1 week change. So DY this week, I highlighted earlier in the week for the members. You can see this big breakout bar here on the 22nd. So if we go onto the weekly here quickly, I'll change this so you can see it better. So you can see this massive sort of cup type pattern that's been forming, and the lower Wyckoff base in there. So you can see the structure from your initial selling climax into your automatic rally and secondary test, and then we had a little bit of sign of weakness there. It rallied up, and then we made a higher low and started to come back out again. So got some sort of spring type action in there and follow through. So this is it's into what we call phase D at the moment. So phase C into phase D. So this is our sign of strength rally, but obviously it's run into resistance here at the top of the range with that bar there, and we've got a supply tail there on the week. So this could start to form. We need to see this hold above the top of the base here. So you want to see it form up and basically hold above, a bit of VCP action before continuing on. Let's go back onto this on the daily and zoom in on this just for a quick one. You can see the cup type pattern that's formed on the broader pattern. But again, we want to look with using Wyckoff and Weinstein together. You can get in much earlier than the traditional cup and handle type moves, as we look at base structures in a much more fractal way. So again, you've got your selling climax into your automatic rally and the secondary test. So you've got a sort of phase A area type in there, then into phase B, and then we've moved out into phase C over here. This is our sort of phase C area. So you've got a spring and test in here, but obviously it's a higher low, so you could just call it a last point of support and a test, then follow through. So we've got a follow through move in there. So you've got multiple entry points. Some people take on the spring, or they take on the follow throughs there, or they take on the follow through day there, or they do on the pullbacks on the tight days in there. So there's multiple entry points in phase C, and then there's multiple entry points in phase D in here. Once it got back through this, so it's minor sign of strength rally here it had, and then tightening up in here before again attempting to follow through. So some near-term entry points in there, and again we've got this breakout move in here, and now the pullback in. So this is what we call a significant bar at the moment. So this bar here from the close to close there, that's your significant bar range. So that's the range that I'm interested in at the moment if I'm looking at this one. So I'd want to see it hold up around half of this bar, ideally not close back below the low of that bar, but you want to see any kind of base form in the upper part of that sort of range there. So at the moment it's kind of holding in that area. So you want to see any kind of basing action sort of chop around in here, ideally VCP type action before making a continuation breakout off to new highs there and up through the resistance. But this one could need a little while. It obviously had a big strong move, so it could take a little while to churn around. But that one's of interest. We go back to our groups. Not much else of interest this week. I don't like staples much. I tend to avoid staples. Healthcare, I don't trade much, especially biotechs, and energy I generally avoid most of. So we've got financial, staples, energy, and healthcare. So lots of this week's movers in terms of groups that I tend to avoid and would rather be in cash than being the majority of those. So not of huge interest, especially pharmaceuticals. I exclude them from my scans altogether, because you get lots of pharmaceuticals pop up in scans, but they can obviously gap on you really easily. So I tend to avoid those. But at the moment, this week, they were the stronger areas. So for me, I'm mostly cash in terms of in my short term accounts. I'm 100% cash, but the long term accounts, as I said, holding the mega caps and about 75-76% invested at the moment in those. So no intention of doing much on those unless we get some major stage 4 breakdowns in the market. So again, overall relative strength at the moment, automobiles, semiconductors area of focus there, software's at 9th place. So they're the three groups that I'm particularly interested in. Computer hardware, which is mostly Apple, to be fair. So that's the areas of strength. Right, let's move on from these. Right, so moving on. So how long are we into the video? So 35 minutes. Okay, let's get on to the market breadth charts now. Let me just have a quick pause. Right, let's move on to the market breadth charts, as it's been obviously a very interesting week for the market breadth, with such big moves in the indexes and the major markets rolling over, including the S&P 500, which has generally held up really well until now, and it's tended to be the growth names that have got hit much more violently, and various leaders have been breaking down over the last 4 to 6 weeks. So we saw, I think the earliest leader breakdown was Upstart following the Mark Minervini interview on CNBC, which obviously lots of people were joking about, but that was one of the first shots across the bows, as some people say, in terms of a leadership stock starting to break down. So obviously it had huge move until that point, and it came off quite dramatically, quite quickly, and then we've started to see other leadership stocks such as AFRM and AEHR. And what else have we got? Well, there's another leadership one coming off. I can't remember off the top of my head now, but there's been multiple over the last few weeks that have started to come off week by week, and they were kind of a prelude to the market weakness. And we were actually in a short-term area of strength. So this chart is my US total percentage of stocks above their 50-day, 150-day, and 200-day moving averages combined stock. So this is a completely unique chart to stage analysis. I haven't seen anyone else do it. I'm pretty sure someone else can make it for themselves. I make it myself in a Google sheet based on the data from stock charts. So it's based on these three charts here. So from the Nasdaq and the three charts on the NYSE. So 200-day moving average, 150-day moving average, and 50-day moving average. So I pull the data out of stock charts for these. You can go into historical data. I get the data out of here for each one, and basically do a Google sheet and make the charts of this. And this has become my kind of market timing model for the last year or so, and it's proved really useful. I basically have two ways of two sort of terminologies for it. So when we've got this 50-day moving average here, which is this red moving average, see when it's above this 50-day moving average and the moving average is rising, we're in a positive environment. So you can see majority of last year from sort of April time, as it started to get back through its 20-day, and then later in April through the 50-day there, all the way through to February this year. So April to February, it was, for the 90% of the time, maybe 85% of the time, it was on positive environment status. And that obviously last year was a much easier year to trade. And as we got into the upper zone here above the key 70% level, obviously that's when we were getting the real speculative moves, and obviously laggards starting to really run. We had the GameStop craze and all that kind of stuff going on around January, February time there. People were getting really excited at the end of the bull run. So as we can see, every single stock in the market, practically 85% or so, were above their short-term, medium-term and long-term moving averages. So it was way heavily weighted to one side, and obviously that can never last. So as we started to come off into later part of February there, and we got back below this key 70% level, we moved into what we called a difficult trading environment. So throughout this year, we've been in the difficult environment. We've had a few little peaks above it, and then this recent rally in October was the strongest move we've had above it. You can see we got above for the majority of October into early November for sort of the above that 50-day moving average, and the moving average started to turn back up again. So we moved back into a short-term positive environment, and obviously sort of mid-October to mid-November was a really, really good time to trade. I think from the October the 4th low in the Nasdaq all the way through to the November the 3rd period, that was a real, obviously practically everything was working at that point. So see, this topped out a couple of weeks ago. We started to break back down below there, so we got back through the 50-day moving average. So I highlighted to members last week that we've moved back to a difficult environment again, and then it followed through again this week, much stronger to the downside. So dropping another 8.74%, and we closed at 38.17%. So you can actually use this chart for stage analysis as well. So you don't even have to look at an index chart. You can just look at the scale on this. So it goes from 0 to 100%. So when you're below 40%, you're in stage 4. When you're between 40% and 60%, you're either in stage 1 or stage 3. And when you're above 60%, you're in stage 2. So obviously we started to break down in late stage 2, and then we started to move into stage 3. And now we've been in stage 3 for the majority of this time. And now we're breaking down below the 40% level again. So we're potentially on the internals in stage 4 here. We still haven't broken below this near-term low. But if we look on the point and figure chart here, we're pretty damn close. So the point and figure chart shows it in exactly the same way. So this is the same chart, but just using the point and figure chart with the bullish percent chart scale, which is a 2% box size with free reversal. So you can see this sort of basing structure we've been making. We broke down in February from the high there. So that was your initial sell point through this area into here, into March. And now we've made another double bottom breakdown here. So when you're in a column of O's, the strategy is to be on defense. And when you obviously make double bottom breakdown, we use the bullish percent statuses. So you're on a bear confirmed and you're on defense if you use those statuses for that. So again, these are the individual charts, so broken down. So NYSE 200-day, you can see we made a lower low and started to break back down there at 50%. Again, 150-day lower low breaking down, and the 50 days pull back off and down to 40% there. So we want to see the 50-day get down to the lower zone ideally. You might not get all the way down to the lower zone with the larger ones, with the 200-day and the 150-day, but you can see in the Nasdaq we came off much earlier back here in February. We've been trending lower all year in the 200-day, and the 50-day got quite low originally and dipped into the lower zone in July and August time. So you can see that September it made a higher low, which was obviously a good divergence and a sign that October low was actually a good entry point at that point, as we were making a higher low in the Nasdaq. And so that gave us a good short-term rally there. But you can see we've dipped back below that again. We've knifed back through that level. So lower low again and getting back towards the lower zone at 30%. So you want to see how this shakes out in the lower zone. And then the reversal signal here is when this gets back through this key 30% level. And ideally, if all three move in tandem. So the best buy signals from this is when all three move together. So from our 2020 low in here, you can see it quite clearly. Obviously, it got into the lower zone. We were in the lower zone for a while. So obviously, we were in a deep stage 4 there. And then as it started to recover through April time, so early April here in the 50-day, so initial signal there, but you can see these were still in the lower zone. And so these got back through in later April. So basically, by the end of April, all three of them had given the signal to go long, and you were in the best risk reward position at that point. So at the moment, we're just coming into the lower zone here. So we don't know at the moment where that's going to end. And obviously, when you're moving into the lower zone, which we were in late February time here in 2020, obviously you can go into a much deeper correction. But the vast majority of the time, with a normal correction, you tend to just get a dip into the lower zone and then get a bounce, and we're out again. It forms a low. So only during major stage 4s does it make it all the way down to the lower zones and the deep of the lower zone down to the 10% level or so. So it will depend where this shakes out. So don't anticipate, don't jump in too early is what this is, how this is used. You wait, you're on alert once you get to the lower zone for a trend change, for it to turn and for a swing low. So you start to look for signs of a potential swing low, and you might start making some test buys early, like nibbling at certain things, but you're obviously also in the danger zone initially until you start to get a turn and it starts to turn back out again. So This is another way of looking at this. This is the distance above the 20-day moving average. So this is our chart. So this grey dotted line in here is the 20-day moving average. So the distance above that 20-day moving average is this one. So you can see at the moment we're more than 10% below that 20-day moving average. So we're near where it's found a low in the multiple times in the past here. 50-day moving average again around 10%, but we're not quite yet at where it's found a low the majority of the time. So it could get a little bit deeper on this one before it could find a low there. Otherwise, that would be if it finds a low and rallies earlier, then that would be a potential sign of strength on that one. This is the individual charts of those. So this is the Nasdaq, and which you can see is getting down towards the lower zone, and then this is the NYSE, which again both on negative signals, both below their 50-day moving average. So difficult environment across the board, but the NYSE has obviously been outperforming in terms of holding up much better and didn't break down until sort of July time, June, July time there through that key 70% level. So it's been on a difficult environment in that area. We moved back to positive environment and now we're back in a difficult environment again. So strategy at the moment is obviously defense as we're in a difficult environment. So I'm both longs and shorts, and obviously focusing on relative strength, areas of strength basically, and not doing anything silly, not being aggressive. You only be aggressive when the market's on a positive environment. In terms of short-term breadth, this is the Nasdaq percentage of stocks above their 20-day EMA. So I highlighted this earlier on the forum and on the Twitter feed, as well as the other ones, the S&P 500 and the small caps, etc. So this has dipped down into the lower zone and getting quite close to its lowest level it's seen. You can see relative strength versus the S&P 500 is exceptionally weak there. So we're looking for, again, the buy points on this one is as it moves back through this key 30% level. So that's where you get the best risk reward. So you've got to wait for that to turn and get back through that key 30% level. See the NDX also hitting the lower zone, same applies. NYSE into the lower zone, same applies. You can see we're getting extreme into oversold levels, but it can obviously get a lot more oversold. So don't jump in too early. Wait for the turn and then wait for the signal. Obviously, it could come as early as Monday, or it could take weeks. It's all about being ready. So once you get into the lower zone, it's having your watch list of your best stocks ready, getting a focus list of the ones showing the best RS, and being ready for those. In terms of once you start seeing all of these various breadth signals give you the short-term go ahead again. So if we look at the NYSE bullish percent index, so I've started with the line chart on this one, as obviously people can struggle with the point and figure charts a bit. So it shows you we're currently at 52% on the bullish percent index. So this is the percentage of stocks on a point and figure buy signal versus the sell signal. So pretty neutral at the moment on this one, but you can see we had a strong negative week, minus 14 there, and back down towards the 50% level again. So it's in a downtrend on the short term there. If we go to, I don't know if we've got there you go. This is the point and figure chart of that. You can see we're on a column of O's, so we're on defense, and what we call a bull correction, as that was a bull confirmed signal up there. So we're on a bull correction, but with a high pole warning, so it's a negative. That's potentially a bull trap there, and then rolled over. So we're on a bull correction and on defense at the moment with the NYSE. In terms of the Nasdaq, you can see it made a lower low here. We're on a bear confirmed at the moment with this one. So again, if we go to our point and figure chart here, you can see it made a lower low, triple bottom breakdown. We've had the breakdown back in February there. 2 is February, so the months are marked up 1, 2. So February is 2, 3 is March. So in February, we broke down from the upper zone below that key 70% level. So that was your initial best sell point there in terms of risk reward. So it's been basically on a bearish all year in terms of the Nasdaq, so which obviously compared to the Nasdaq market overall has obviously been trending higher, but there's a lot of internal stocks it's been trending higher on very thin leadership, and the leadership has been thinning out as the year has gone on. So that's what this is showing, and we've seen from the likes of the IWM that we've generally the vast majority of the stocks have gone sideways, and it's been a choppy environment for the majority of the year. And people like ARK have been really struggling, and various other ETFs that were leadership ETFs last year. So that's what that's showing at the moment. So again, it's on a bearish signal at the moment. So in terms of our weight of evidence so far, we're on multiple bearish signals there. Now MOSC advanced decline line here, it did break out back in October there, and we were on had a positive signal, and then it started to roll back over again. So we needed to see that hold at the 50-day moving average, but it didn't this week. It failed and has fallen back into the range again. So this has moved back into a sort of neutral / bearish. If we look at the Nasdaq, again below the 50-day moving average on that, and making a lower low. So this one is also on a bearish signal there. If we look at the momentum oscillators, getting towards the extremes at the moment on those, and momentum index here is trending down. McClellan oscillator, again getting back down towards areas where it's made a swing low in the past. So on the near term, it's looking like it's got a potential to make a near term low. But if we zoom out a little bit on this one, you can see there are multiple periods where it's got a lot lower. So although for the bulk of this year, this is where a swing low has formed, there's obviously, if the market is moving into stage 4, and then it could obviously go much lower. So just be alert for that, and don't anticipate that just because it's near a prior low that it's gonna jump in aggressively. Obviously watch for the turn, and basically wait for the signal to form. So again, NASI, same sort of price action there. So in terms of it's getting near to a near term low, but if we zoom out on the MOSC one, you can see it has got to much lower levels, all the way down to 120 in 2020, and obviously down to about the 100 level multiple times in 2018 there. That was a stage 4, and that was a stage 4. The vast majority of these other ones have been just stage 3 or just general corrections within stage 2. So if it's just a normal correction in stage 2 or stage 3, then we would expect it to bottom out in the near term here. So keeping an eye on that one to see what happens. New high, new low. So this is the MOSC. You can see we started to pick up on the new lows in the MOSC for the first time. This is the most amount of new lows that this has had this year, I believe, in terms of the daily. So yeah, just about. We did have a peak up in March there, so second highest at the moment, but making a higher high in the near term, and much higher than we've seen in the last 6 months. So above this key 100 level, you can see the new highs has dropped off and was low down at 20 Friday. The Nasdaq has been peaking for a little while here, the highest amount all year into November here. So this has been giving some early clues. A cumulative chart still above its 50-day moving average at the moment. So went on to a buy signal back in May last year, so has remained on a buy signal throughout. And then if we look at this, the 5-day average of the new high, new lows. So we've got the 2018 stage 4 decline and the COVID low down here. Both had really massive declines there with lots and lots of new lows. But you can see this is our worst that we've had now throughout this year in terms of corrections. So lower than the September, August and September corrections now. So we need to see this recover quickly, as it's at a critical level here. If it continues from this point, then we're potentially moving into stage 4 territory on that one. Next up, the cumulative point of figure breakouts minus breakdowns. So this is the custom chart that I run. So again, made from double top breakouts and double bottom breakdowns on the point of figure chart. So it gives you kind of a much more sort of equal weighted kind of look at what's going on in the market. You can see we've been in a very choppy sideways market for most of the year. We did move above the 20-day moving average, and this is what I use for a positive environment, and below the 20-day for a negative environment. And obviously when it's in between the two, it's kind of in a neutral negative or neutral positive, depending on which way it's coming from. So you can see it's knifed through both of those in the last week. So we're now in a difficult environment again on this one. You can see just below that there, still in kind of the range that's been in for most of the year. So this is looking very similar to what we've seen on the likes of the Russell 2000 and the QQQJ, etc., where they've been basing for the most of the year, and then it's had a move out and then it's pulled back in again into the range. So if this starts breaking down and making lower lows, then that would turn much more negative. But at the moment, it's kind of on a neutral / difficult environment rating on that one. This is another way of looking at that. So this chart here, so the red line is the 20-day moving average. So this measures the distance above or below the 20-day moving average. So the 0 line is the 20-day moving average. So how far it gets above or below that, it kind of gives you clues. So again, for extremes and for also using them, it's got its own moving average on that. So when it's above the moving average, it's positive, and when it's below, it's a negative. So you can see we're below that moving average, and we've been in a negative for a little while here, but we are getting towards a near-term extreme. So potential for a near-term low. Lots of breadth charts are hitting near-term extremes. So unless we're getting hugely negative like we did in stage 4, then we're potentially moving towards near-term extremes, and so we could be looking for a swing low in the coming week. Another thing that I look at quite regularly is another website. It's got a free area on the website. They obviously have a service where you can look at the effective volume between the large players and the small players, and they have their own models and stuff like that. But if you go to the ETF review section within effectivevolume.com, you can look at the large player volume for the small players and the large player volume and the small player volume separated out, as well as the combined large and small player volume, and you can apply stage analysis techniques to that chart. So this is the QQQ, for example. You can see we had a stage 4 decline into stage 1, and then we've been in stage 2. So we're now forming stage 3 on that one at the moment. You can see the large player volume was good through October, was accelerating, and then we've based out through the November period here. So we've been going sideways. It did come off a little bit there, but we're not yet made lower lows on that, so it's holding up fairly well. If we look at the IWM as the next one, you can see again pretty much going sideways. Small players have been selling off throughout November, but the large players have generally been holding up there. So again, we look at the cumulative chart of that. You can see it's got below its near-term moving average there, so potentially on a stage 4 on that one. The S&P 500 has been dipping off a little bit through November here, so topped out in early November and then has rolled over. The big move down the other day on the 22nd there, and it made a lower low on Friday. So the S&P 500 has been looking a little bit weak there. So out of this stage 2 into stage 3 and then rolled over. So we're potentially moving into stage 4 zone on that one as well there. So effective volume is looking, it's kind of mixed on the QQQ to flat, and then it's looking weaker on the IWM and the S&P 500. You can also look at they have the ultra long QQQ, they have the ultra short, so they can help sort of gauge what's going on as well. So the ultra short QQQ, you can see the large players have been piling into that in the last week there. And then if we look at some of the other areas of the market, so we've got the triple, I think you have like the triple long S&P 500 ETF. So you can see again, large players have been adding into that over the last week or so. So, and the cumulative of that has obviously moved up into potential stage 2 there. So looking fairly bearish, but you can see the QQQ is holding up reasonably well. So sort of mixed to bearish at the moment on that one. And then finally, this is again the plus 180R and minus 180R charts that I talked about earlier on. So we go all the way back to earlier in the video. So these ATR bands here. So this bar, the middle range here is the 21-day EMA, and then this bar above is the plus 180R level. So anything above that 180R level is above the plus 180R, and then this minus 180R level there. So we look for anything below that minus 180R level is in a downtrend. So stocks in an uptrend. So early in the year, kind of topped out in the high 60s here in January and March time there. So you can see, but when it gets, how I've kind of discerned this chart is that when you tend to, when it gets below the 10% level on the +1 ATR chart, it tends to be near to a swing term low within a few days. So at the moment we've dipped back below that 4.87%. So the second lowest reading of the year on Friday. So we're back into a potential zone at the moment. So if you look at it here, so when the -1 ATR level is above 50%, I mark it as green and as a positive, and when the greater than 1 ATR level is below 10%, I mark it as a green, so positive. So when both of these are positive, then that's a sign for me to start looking for potential long entries. So September the 20th, we've got the first both of those moving on to that. So that started to hit some test buys around the 20th of September and did a fair amount of buying into that. So the actual buy signal there was on the 22nd as it moved back above the 10% level, and this dropped back below the 50% level. So that was the 22nd of September was a near term sort of buy signal from this one. So again here, then the other way around, it started to top out here. So on the 3rd of November, you can see we got above 50% on the +1 ATR level. So it was too extended. So we'd got above the 50% level, and then on the minus, it got below. Where are we? Down here, it had got below. So go back into that. Where am I looking for? So you can see on the 3rd of November there, both of those. So that was the first sign to start sort of trimming back using this indicator. So and then it started to. So at this point here, from the 5th to the 9th, it was showing that basically everything was too bullish and everything was too bearish. So that's a point to start taking profits basically. And then once it starts to move back down and out is a sign of a trend change. So at the moment we've got the first green now on the 26th. So we're back below the 10% level on the 1 ATR level. We're at 48.87%, so 49% on the less than. So potentially with 1 more percent, I think I'm giving that one the benefit of the doubt that we're actually in the target zone again. So we now need to be looking for potential swing low and for long entry points to start to form using this chart here. So if this starts to reverse back out plus above the 10% level, then that would be a buy signal for this one. And again, same for this. If it gets above that 50%, starts to roll back over, then that's a buy signal on that. So I do combine these two into a cumulative chart. So you can see for the bulk of the year, it was going sideways, but recently from October, so from mid-October onwards, it got back above that 20-day moving average there and started to break back out again. You see this recent pullback hasn't made much of a dent in it. So this has been the October rally has shown a really strong amount of stocks getting back above their 1 ATR level versus the stocks falling below their -1 ATR level. So although we've picked up in the last week or so, you can see the vast majority of the time we've actually been much more weighted towards stocks in a short-term uptrend. So this is still above its moving average. So this is still looking positive. So again, looking at this in terms of being in a near-term level below that 10% level, and this being in a extended above the 50% level almost, and the cumulative line being in an uptrend, I would say that's gives us a potential signal for this one of a short-term low is potentially going to form in the next week. So we need to be on alert for some tester buys. So I think from the general weight of evidence, it's at the moment the weighting is towards the bearish side, but as we've shown from multiple charts, we've got some near-term sort of swing lows potential to form in the coming week. So we need to be on alert for that, as obviously when everything is really bearish and we get to extremes on the short term, you can get some strong moves on the short term to the upside. Whether we then continue down on following a bounce is anybody's guess, but basically all you can do is trade what you see. So from the market breadth, the weight of evidence is obviously leaning towards the bearish side. So we're on defense currently, but we're on alert for a potential swing low to form as we're hitting some extremes, is how I'd put that. Right, I think that will do. Thanks for watching, guys. Hope you enjoyed it, and I will see you on part 2 of the video tomorrow. We'll be going through the individual stocks from the weekend watch list and some of the any potential longer term sort of position trade type stocks that are of interest or starting to form bases. So we'll be covering that tomorrow. So still got to put in the work for that yet. So at the moment, let's have a good weekend, guys. And I appreciate you watching. I'll see you on the next one.